Good afternoon, everybody, and welcome back to Schwab Coaching for our next topic, trading breakout patterns. I am your host, Kevin Horner. Thank you all for being here today. We have plenty to get to for you all. A series of charts. We're going to look at some new ideas of example opportunities traders might consider. And then, of course, we've got some example portfolio positions that need to be addressed as well. And I was just rewatching last week's episode to make sure that I'm tying things together for us. And I really can't wait to get to some of these charts that we looked at last week, and one of which we did not take a position on. And I just want to revisit that conversation because I think it's offering really an exceptional case study of the ways traders go about placing trades, meaning simply, do we buy on breakouts the moment they happen? Do we buy on breakouts after retests? How do we approach this process? And again, as traders, how do we build our own processes so that we are providing ourselves the playbook with which we will address the market on a day-to-day, trade-to-trade basis? So plenty to get to with all of you. So I'm glad you're here. I see some familiar names in the chat. I'm excited to have you all. I've also seen a couple of questions already that I'll try to get to. Greg, yours in relation to stop orders, I'd certainly like to speak to. Can you provide just a little more context for me there as to what you're referencing in terms of slippage? I'd be happy to address manners in which we set stop orders and that process for you. But say hi to my friend Cameron May in the chat. He's going to monitor things for us there. And if you're not already doing so, I think you might be missing out, everybody. Take the opportunity to follow us on X at Cameron May CS and at Kevin Horner CS. Try to get you some notable content on X throughout the week here. Your follow is greatly appreciated. Just another way that you can engage with us outside of the classes that we host. All right, let's get to your disclosure detail, everybody. I'll remind you that our discussion is exclusively informational and educational. We do not make recommendations nor endorse a particular strategy or approach to trading in the marketplace. We also talk technicals quite a bit. Remember, technical analysis should be considered complementary to your overall fundamental research that you're doing. We also want to remind you that options carry a higher level of risk, are not a suitable investment strategy for all investors. You do want to familiarize yourself with the characteristics and risks of standardized options prior to placing these trades, probably prior to making your requests for being approved to place these trades. Remember, we do require your approval for options on each of the accounts on which you would like to trade those options. And it's also important to know that while we work here in a paper money version of the thinkorswim desktop application, if you're trading short options in thinkorswim paper money, you will not have an option assigned ahead of option expiration. However, in real life, this can occur at any moment in time, and it's imperative that we as traders know this. So when you're working with real money and trading in the real live markets, you can be assigned on a short option position at any time up to and prior to expiration date. It's also important to note that that can even occur if your contract is not in the money. So you might not expect to be assigned early. You might not expect it because it's early in the window. It's also not in the money. You may not anticipate it, but it can happen. You do need to be aware of that. In terms of an agenda today, everybody, we have an announcement that I'm going to run through briefly with you. Then we're going to get to some brief market overview. We're going to look at the S&P 500 and the NASDAQ 100 quickly before moving to a couple of new example trade opportunities. And then, of course, getting to some trade management. Like I said, I want to review some of the prior symbols and charts we have seen just to kind of further the conversation, because inevitably as time passes, some of the comments made in prior sessions start to hold more water than they may have originally. We actually have new evidence that validates some of the thought processes we considered previously. So we're going to look at some of that with you all today. So the lead off today is an announcement about shifts to our schedule. So our schedule's changing a little bit as we head into 2025. No changes before then, but I want to let you know that if you take a peek at our calendar, schwab.com/coaching, come to the live and webcast virtual workshops here and scroll on down. So I've skipped ahead to January already. But one thing you can do if you're interested in coach to coach review, just come down and select my name. and it's going to highlight the classes on which I am going to be hosting going forward here. And one of those is this one in particular. We do offer the trading breakouts and what have you, but it's going to be combined as a class with another class as well. So we're going to basically be bringing a couple of classes together as we move forward here. And then additionally, I'll be taking over the getting started with stock investing class, which is a good class for those of you looking to get that base knowledge. I don't want to say the low-hanging fruit, so to speak, but rather the stuff that is going to be the essential platform from which your learning can really grow. So that one is the getting started with stock investing. That's going to be on Thursday afternoons. You can see that one right here. Of course, the Trader Talk in today's market will absolutely remain. But what we're looking at in terms of this class is going to be trading price patterns as opposed to breakouts specifically. So we're combining the trading flag patterns class and the trading breakout patterns class into a trading price patterns class that is going to fit this time slot on Wednesdays. So that's what you can expect as we move forward here. Don't have it in the calendar just yet, but that's what we can expect. So just wanted to point that out. And then, of course, I'll remind you that this calendar continues to be an excellent way for you to keep apprised of what we are up to and when. So maybe book. Okay. So with that, what do you say we get to a look at what's going on in the S&P 500 today? I'm going to bring us over here. We'll go strict to the S&P. We're up almost 1%, getting a little bit of a follow through on today's original open or the initial open of the market. The conversation Brent and I had this morning was pretty optimistic based on the fact that we opened quickly higher, moved through the intraday R1 pivot point right off the jump. And what I find notable from a short-term standpoint today, and I think many of you will as well, is that not only have we been up for the day, but we have maintained that light, I think it's light blue, 20-period simple moving average there, intraday exponential simple moving average. So that is 5-minute bars, of course. And beyond that, when you see this maintain the approximation of the exponential moving average for the extended period that we've seen, that becomes support for the day for a lot of traders. And so what we've had is a wonderful open with follow through on the day. Let's see if it carries to the close today in the S&P 500. In fact, we're going to migrate over to the NASDAQ and we're going to see if it looks the same. By the way, notice where we are. We are basically right back to highs. 6,090 is the last trade. And I think if I put up the bubbles, there you go, high, low bubbles on the chart. Yeah, we made that high on Friday. So we are at a spot where we are looking to challenge that high as well. So let's see how we look on the NASDAQ, everybody. Okay, NASDAQ giving us an even greater move now, 1.8% up, break of a very quick bull flag. I remember recently hearing from some of you asking about bull flags. How long can they take to resolve? What is a time frame that is appropriate for it? Well, the speedy bull flag, the resolution over 2 to 3 days, can tell us something about a bit about the momentum, and that's what's occurring here. We have pushed to new all-time highs in the NDX after a very quick, brief pullback and resolved bullishly. Really hard to dislike this, other than the fact that we have pushed once more into this upper band that has more or less been a bit of a resistance for us, right? So we're through that upper band. Now, this is getting to a spot where some traders would say, yeah, you know, now that we're into that trend line from which we've retreated numerous instances over the last 4 months, some traders would use this as an opportunity to take money off the table as a means of selling into strength. Again, this gets back to the discussion around what is it that the trader wants to do. Are you a trader who is a believer that selling on strength is the way to go? Or do you prefer to be a seller on general weakness when you get it? And the trouble with selling on weakness, and this is not to suggest that you need to sell on strength in lieu of selling on weakness, but rather notice the difference in levels here, everybody. You'd have to give up almost 750 points to be a seller on true weakness here, right? If you wanted to sell only when you broke the uptrend line or maybe the 20-day moving average or took out the last level of horizontal support, gang, you are giving up profits to do that. So always be considerate of what is your preferred method in terms of selling, particularly selling in profitable trades. Are you good risking some of your profits? Sure, in which case maybe you're using stop orders along the way. Some of us are using a combination of those two things, right? Selling a little bit as we move higher, but also raising stops along the way. So that's how we look on the NASDAQ. And of course, I should just jump right back to that 5-minute bar and point out the exact same thing here. Gapped R1 intraday, held the 20-period exponential moving average thus far today. So maybe perhaps we are looking at one of those consistent days where it's just going to hold that 20-period exponential moving average. Villager, I understand there's no trouble in being a buyer on strength. That's also a process by which many traders are happy to engage the market. Remember, as a trader, yeah, I know we all want to buy low and sell high. That's a real common thought. But if you're a trader, it's perfectly fine to buy high and sell higher, as we are going to see. In fact, why don't we take this as our opportunity? And let's just take a look at some new thoughts. So first of all, we're going to start out with Alphabet today. Google, Alphabet, take your pick. So this one has broken a couple of key areas, not just today, but with yesterday's price action, taking out some intriguing levels. So the first one being a quick move through kind of like this, right? This little very brief downtrend after failing at this ledge around 181, 182. And we retreated to find the 200-day moving average. And we battled back right back into this ledge. And then there was the announcement yesterday of Willow. I'm just going to bring you back to the headlines here. So Alphabet stock was soaring, moving on according to Barron's. And it's really the announcement of the Willow quantum computing chip. And the market really, really liked it. And so what we got was a wonderful gap higher. So as a potential breakout, yesterday might have been the ideal time to talk about this, of course. However, when you look at the continuation today, an area of note is the prior highs. And we are now trading through the prior highs. Now, this is, of course, tricky because once we are at new highs, many traders start to get a little concerned, right? Or a little uncomfortable with the idea of either buying at new highs or positioning trades when at new highs. And I can understand it. You know, it's difficult to be a buyer at new highs. However, there are many ways to go about this that can be limited in scope. And more specifically, what am I talking about in terms of limitations? Limitations to your risk. So a lot of traders might consider an option strategy with a defined risk plan, which basically lets you in on a, for example, a long call scenario. Maybe you'd buy a call at a given strike price, sell another call at a further out strike price, looking to make the difference between those two contracts, the spread minus what it costs to put that on. And what's nice about that, if nothing else, is that the trader knows definitively what it is they are risking on the trade right up front. And that differs quite a bit, right? Because if you're buying underlying stock here, not only are you devoting potentially a lot more capital to own a position in Alphabet like this. I mean, 100 shares of Alphabet will cost you today $19,360 ballpark, right? That's not a small chunk of change. But as we can look over here at the trade tab, on Alphabet if we were to believe we have the opportunity to take on a long call position for maybe the remainder of this calendar year. Do we go out to December 27? And do we look at something like an in the money value, something below our current market value, and say we go down to 185? Okay, well, there's a $10.30. That means it would cost us to control 100 shares of the underlying stock. It would only cost us $1,030 right now. Okay, so that's a pretty big discrepancy versus the 100 shares of the underlying stock. So this is one consideration. And one thing that many of you are going to enjoy about having selected that 185 strike on such a trade is this delta on that contract at 78 cents. So what does the delta tell us about this given contract? It lets us know two pieces of potential important information. Number one, at 0.78, this is reflective of what we can expect approximately on a per contract basis to increase in price for a $1 move in the underlying position of Alphabet, GOOGL. So if, for example, Alphabet were to rise from here $10, okay, from 193 to 203, then the expectation would be that the delta would go up about $7.80. Pardon me, the delta would go up, but the bid and the ask would go up with it about $7.80. I'm just using a variation of a $1 move, kicking it up to a $10 move. So just moving the decimal over a little bit, right? So, the $10.30 contract could be valued at over $18 if Alphabet were to move up by that 10 points. Now, in this scenario, yes, the trader would have risk of whatever they spent on the position. An alternative could be to go ahead and spread that off by owning a contract out the money a little bit. So we are looking at the 185 long. And if we wanted to reduce our cost, reduce our risk exposure, for example, let's say we went to 200. Well, what are we looking at in such a trade, everybody? Our cost would be, let's call it $8. I'm just going to round this up to $8 just for easy math. So if it cost us $8 to put on this trade, the opportunity for profit is the difference between our strike prices, $15, and our net cost, $8. So as we'll see when I hit confirm and send here briefly, our max profit opportunity is $700 with a max loss opportunity not to exceed $800. Now, from a risk reward standpoint, I realize that when we deal with options, we have to take a different approach as to when we work with underlying equities. And I often discuss with you all the idea of working with a 1 to 3 risk to reward ratio basis. But in a scenario like this, the other consideration is what that delta calculation might also be telling us. Yes, I have a 79-cent move on the dollar for Alphabet, but it also tells me or implies that there is an opportunity of almost 80% likelihood that this contract at 185 will be in the money on expiration date. Okay, that doesn't necessarily mean that it's going to be in the money for the periods leading up to that. So you have to keep that in mind, but it absolutely can help me to make some decisions about the various strike prices I might want to work with. So the hope could be, yeah, I'd love to be taken out at $200. I'd love for the stock to close over $200 on December 27, because then I reach my max gain potential of $700, right? Based on how this trade may play out. So this is a potential opportunity. Now, I've also seen here, Paul, you're a believer maybe in selling here, and that is absolutely perfectly appropriate consideration, Paul. Why? Well, a put vertical is bullish in nature as well, because you are in that case you might be selling a put at say 505, pardon me, 195, and then spreading it off down to about 185, where you'd buy that contract. Let's look at that real quickly. It's not as upside bullish per se, but it is bullish in nature, because in order for this to be profitable, you do need the stock to continue higher, or at least to hold the strike prices you're working with. So maybe the trader sells the 195 put and buys the one. If we're keeping our $15 spread strikes consistent, they would work with the 180 as the worst case scenario, locking into, let's say that's 4.5. Just again, easy math. So a $15 spread here, right? And so you're bringing in $450. But remember, when you bring premium into your portfolio, that becomes your max gain. So max gain here would be the amount we credited, 450. But if Alphabet didn't continue higher, then we have a max loss that is more than double what our max profit is. Okay. So I need you to be considerate of that, right? Considering both are bullish in nature, one has a higher risk factor than the other. And Paul, you're absolutely right. Start working with a different delta. I went with something with a higher delta, right? Actually, I was pretty close there at 190. Nope, I was using the 195s. So the 195s are 50-50 opportunity potentially of being in the money at expiration. So, I could see what you're saying. Maybe it's 190 down to 180, and then your risk factor is a much less. So it's all about preference, everybody. Do you like to be a collector of premium? Do you like to be devoting or deploying liquid funds to the trade? We're all different. We say this much all the time, everyone. Having a plan and knowing how you want to approach things is imperative. Many of you are only sellers of contracts. Many of you say, yeah, I don't want the hassle of putting my own money out there. I only want to be selling and bringing premium into my portfolio, and utilizing low delta amounts to do it is an intriguing way, because low delta, when you're the seller of the contract, implies low likelihood of that contract being in the money at execution, therefore low likelihood of you taking on position after the option trade. Or remember though, if you're the seller of puts and you're not spreading it off, you're always at risk for taking on stock. And if you're taking on stock, or at least putting yourself in a position to take on stock by selling a put, you darn well better be comfortable owning that stock. Okay. So make sure, that is such a key component. I have to restate it. Make sure if you are selling puts, you have to be comfortable owning the stock, not just owning it, but at the strike price you've chosen to sell your put. Very, very much very, very important. Now, truth, why am I selecting 16 days to expiration? In this case, it is part and parcel of the narrative surrounding the overall market here. I mean, everything we've heard and discussed relative to the overall broad market since the election has been bullish toward the end of the year, and then it's a wait and see. And so, not to suggest that we have to stay bullish between now and then, but it gives the trader the opportunity to consider staying in a bullish trade between now and the end of the year, and utilizing the well-defined risk approach, where you're setting your levels, setting your strike levels at amounts you're comfortable with. Okay. Hopefully that helps out in terms of all the questions here. Lots of good questions, by the way. I do see we have a survey opportunity. Always love your feedback, everybody. Take a moment if you're not already, maybe you haven't already offered it up. I want to hear from you. Please click that link. It'll just open in a browser window right next to this one, and then you can get to it post-show. I would greatly appreciate that. you know what? We're going to go back and we're going to rebuild that long call vertical, putting us in position to participate in continued upside and do so with a smaller semblance of risk, just slight bit less risk, okay? Doesn't mean it's proper or one versus the other, just the example that I came to the class with today. So let's go ahead. We're going to go back and do the 185 long call for December 27, which we will, it's already moved against us 70 cents, everybody. I can get verbose from time to time. And so, yeah, we may have cost ourselves $70 on this one, but we'll go from 185 up to sell the 200, our net debit at 807. I'm going to go ahead and just make this a market. No, that's silly. We don't need to make it a market order. Let's just see if we can get in at our $8 limitation there. We'll place that. And again, I'll just remind us of what we're looking for. Over 193 is our break even. Our max profit is $700 if the stock closes over the $200 short call on expiration Friday. Our max loss is the cost of our trade. You're right, Frankie. I was speaking specifically, your question, why do you need to be comfortable owning the shares if you have downside protection? You're absolutely right. In the short put vertical, where you're incorporating a buy put to cover, right? So you're protected. That's less of a concern. But you still have to be comfortable owning the shares, right? You still have to say, all right, I'm good. I want those shares. In the scenario more so that I was speaking to is the risk of selling the put without utilizing the protection on your original trade. You could always pick up a put after the fact, but of course, if you've sold a put, the stock drops through your strike price, you get put shares. In that scenario, then your put that you're purchasing becomes more costly, right? So it makes a lot of sense for many traders to ensure that they are protected by putting on the short put first, follow it up immediately as part of that original trade with the long put, so it's all incorporated into your cost, and that makes a lot more sense. So great that you asked for clarification. I do appreciate the question, but I wanted to hit on that specifically. So we have the trade in Alphabet. Let's jump back and let's talk next about Tesla. All right, so Tesla had a massive move this week. It's so unfortunate, everybody. And if you'd like, you can go back and rewatch the classes that from last week, as I did in the last hour and a half here. And we talked about waiting for the breakout. And boy, we would have been rewarded if we had positioned ourselves for that breakout trade. We did not. The opportunity at the time likely was a buy long stock on a breakout, or maybe buy a long call vertical scenario again, if we could get the stock to close over our price. We did not put that in. However, what I spoke to largely last week was the need to be patient, the need to allow the breakout to occur. And we often say, we don't know how long the breakout can run. We don't have clarity about that. We only have expectations. And many of you might not be comfortable buying originally on the first breakout, right? I mean, that's okay to buy on the first breakout, but it's much more likely that that is a comfort for the aggressive trader. And if you did that in this case on Tesla, you would have been well rewarded. Even if you bought it at the high on the breakout day, that high was 375.43. If you'd have bought it at that high, let's see, right about there. And we took it to the peak where we hit to just moments ago, 417.86. How about that? A nice little 11% rally in a big stock. Tesla here up 11% just from the high on the breakout day. So even allowing the market to close and saying, all right, I got the close above the breakout. Now I'm going to take a little trade and let's see what happens. Man, would have worked out great. And the conversation we had was just being patient, allowing it to occur before positioning. Now that we are where we are, though, I think it's a probable wait and see yet again. Why? let's back this out. Let me eliminate all these lines. I got a lot of stuff in here. But the most important line might very well be this one, prior highs. And we have traded up to the prior highs. Prior highs were 414.50. We're already above it. Question is whether we've got any ability to continue higher. Obviously, we could, but how would many of you handle this? I mean, we're looking at a stock. If we just go back to when this move really began, it began back at this low, 237, everybody, 237. So the question, I guess, is how do you manage or maintain something that's gone up 75% over the course of 5 weeks? Many traders would take the opportunity to maybe pull a little bit of profits. You're at resistance. Doesn't mean we can't continue. Just means I've made an exceptional trade. I should be very proud of myself. 6 weeks. I mean, we're not even at the conclusion of the 6th week. And here we are up 75%. Many traders would pat themselves on the back and sell portions here. Or you might start to position some protective strategies. Alternatively, maybe you're putting on a collar for the short term just to protect, or maybe you're just going to let it run. I mean, again, my encouragement is to follow through on your plan, whatever that plan was that put you in a position that allowed you to be here in Tesla at new all-time highs. That's the plan you want to stick to. My hope is that you've already built that plan, and all you're going to do is refer back to the bullet points you set for yourself. That would be ideal here. For our process, I'm afraid we're going to stay on the sideline here yet again for the short term, because I think, and I want to see 3, 4, 5 sessions of sideways, very minimal give back. I would like to hold these, basically the new move we've made over the last, say, 40 to 50 points. I'd kind of like to hold on to something in the neighborhood of like 20, and maybe expect, Chris, and some of you pointing this out, maybe expect the creation of a handle. That could be a longer development. You're absolutely right. I love the idea of thinking about the way that this can go and what kind of pattern might develop here. Is it possible it breaks from here? Absolutely. Like almost immediately? Absolutely, it's possible. We never want to think that it can't happen. I mean, that's both positive side of things and the negative side. We got to consider. I might think this is going to happen, but if I'm wrong, here's what I want to do. That's the process we want to lean into, right? So, you know what? For now, we're just going to sit on our hands. Like I said, I just don't want to put us in a sticky wicket by positioning here in expectation of a breakout. I feel like I'd be more comfortable allowing an example trade to go in our favor and continue higher and miss the boat than I would to deploy money and be proven wrong. That's just a preference associated with my tolerance for risk. And again, big part of everything we do involves our tolerance for risk. Okay, so with that, let us take a look at what is going on in our example portfolio. Oh, you know what? We got one more. I'm sorry, guys. We were talking about Apple as well. I mentioned needing to allow Apple to come back and test our breakout so that we could get the conservative entry on a breakout. Same thing. We see this is broken and just continued. Now we've got 2 weeks higher, and we haven't taken the trade because we did not have, we had an expectation of the throwback move here. And I'm still expecting the throwback. I mean, it would make sense. 20-day moving average getting caught up to the breakout. Entrance nearer 236 would be excellent in terms of the current trend, and it would be a more conservative entrance for the trader. Again, if you want to participate in the breakout, many of you will do so in small portions of what you ultimately want to own and let it go, see what goes on, see if you can participate for a period of time. And that way, if you're thrown back to the breakout, you've got dry powder to add at the breakout level, but also if it continues to run, hey, you didn't miss out. You're participating. It might not be as big as you wanted originally, but you're still participating. Okay, last week we took on a position in Unity Software. Let's go back to our activity. Here we are, Unity, 285 shares. We built this trade properly, I'll point out. And what I mean by properly is we used an understanding of our exits plan, our downside exit target, our upside profit target, and we built that or built the trade owning 285 shares based on those expectations. So let's look at it in the chart. Oops. All right. So here we bought on this day, the breakout day, the 4th, a week ago today, and the breakout has continued, but we are in the midst of a little bit of a bull flag here, aren't we? So the question becomes, have we done anything in this pattern just yet that would encourage us to raise the stop order? Now, I posit that right now, no, we have not done that yet. Now, why is that? Well, I'm of the belief that I want to get to a higher high in the break of the bull flag. So I want to trade through, in this example, the highest high we've made on this rally, which is right here at about 28.60. And then I can push my stop to just below here, the lows we made in the flag. So would that do a whole lot for me? Because that's going to be right under 26. It wouldn't be bad. I mean, it would go from 24.75 to at least 25.75. So I would have the opportunity of reducing my risk factor by about $1 a share or $285. Now, a reminder, we know these stops don't guarantee our prices. They simply allow us to manage and mitigate risk. Can't guarantee it won't turn out properly or that it will exit us at our stop. But we're going to wait and see on this. We do have the limit up there, and that's perfect for us because if it gets to the limit before I have an opportunity to raise the stop, terrific. We just manage to profit and move on. That's a great scenario for us, right? I mean, if every trade I made is such that I can quite literally step away from my laptop or my handheld device and not pay attention to what's happening at the moment and allow the trade to get to its max to what I set as profit exit, and I'd move on, great. I mean, there's nothing better for me, at least, than placing a trade, having it bracketed, and then just the comfort knowing that one of those sides of the trade is going to execute. I don't know which, but at some time down the road, one of those is going to go, and I'm either going to be stopped out and I'll take a small loss, or I'm going to be taken out at profit and I'm going to be happy and I'll have cash to put to work later on. So for now, no changes on Unity just yet. We need to go back to the monitor tab here. All right, we've got a trade in Fox. Now, generally, everybody, Fox Corp, we don't generally make adjustments along the way when we're in losing situations. So we're going to look at Fox A briefly here. And this is a great opportunity to remind us of this process. Again, we are good with our stop where we are. Now, whether we like what we see here or not is irrelevant, right? What I mean by that is I am not going to concern myself with the fact that we're below the 20-day moving average here. Okay, why? Well, I've already built my risk tolerance. I have a stop order in, and I'm comfortable there. Now, if I decided that I don't like what I see, I want to push that stop order up a little bit, and then I'll reduce my risk by maybe $1 to $1.50 or something like that. I guess I could take that action, but that would not be really necessary given the way that I built the trade, right? The process by which we took the trade on was, let's buy on a breakout and set a stop beneath the breakout spot, which we did, and see how long we can get it to run. And so at this point, we have managed to run a little bit, got all the way up to that 47.59, but our exit strategy is a little higher, 52.20. Okay. Now, why is that our exit? Well, let's see how we did this. I've got this line in here. Oh yeah, I think we put this on. I'm going to add this back. Let me put my trades on here, everybody. So we'll go back to equities. Let's see, show my orders. There's show trades. There we go. All right. So we bought it at 47.33 right here. And right, that green arrow. All right. So what we used was let's see, we bought here the 20-day. I think we used a measure of the average true range to build our exit strategy here with the stop, everybody. So just looking at the history of price action over the last 14 days when we placed the trade gave us the stop here at 40, from entrance at 47.33 to a stop at 44.60, risking about 270 a share and looking to make about, what do I say, 52.20, so about $5 a share. So about a $1 of risk for $2 of potential reward. Now, like I said, as a trader, you could choose to raise the stop into here and try and mitigate some of that downside risk. But you've already done the work. It's not necessary that we raise the stop. I'm of the belief that when you've gone through your steps, you've built and determined the exit strategy to both above the market and below the entrance, etc., that you just let the work that you've done play out over the expected window of time. I don't know that we need to concern ourselves with raising the stop unless we've made the high. And right now, we haven't made that high. We haven't broken to new highs. So if I remove all the draw tools and let's just clean that up. We'll get rid of the trade. Whoop, not that. Show trades. There we go. So it would be a break of this little, flag, right? It's kind of still a flag, just a little lengthier in nature. And if we could just trade through that downtrend line over about 47, 48, well, now we've got reason to start raising that stop. In the meantime, we could meander, we could dabble, we could get some intraday moves, some of those tails on an intraday basis below the trend. We don't just want to get stopped out just because we raise the stop. I don't want to raise the stop for the purpose of getting stopped out, right? Right here feels comfortable, and it should enable us to manage some of this uncertainty in the triangle here, in the flag. So allowing it to continue to hold and not doing anything just yet makes a lot of sense, at least in the short run. And then a quick review of, oh yeah, now I'm reminded. So this is all, we were looking at the height of the of this move here, everybody. This breakout, on the weekly chart, 5-point rally created that flagpole, and that gave you a potential on a break of the flag to make an additional 5. So that's kind of what we're looking at here. So again, no adjustments to the Fox trade, but continually give consideration. Can I raise the stop? Really what I wanted you to think about is whether it makes sense to raise the stop just yet. And I'm not sure we're there on this example trade. All right. So we are at time, everybody. I'm going to wrap it up right there. I want to thank you all for being here. Big thanks to Cameron handling a lot of these questions in the chat for me, but also big thanks to all of you. Your questions and comments make this class. It certainly makes it a lot more enjoyable and fun for me. So not only a thanks for bringing those comments and for being here, but thanks for following and thanks for coming consistently to the segment. Now, if you're catching us in the archives, remember you can utilize the comment section right beneath the presentation window here to submit additional comments or questions, and those come to us directly as well. So I'd love to hear from you that way. Don't forget, we have a survey opportunity there in the chat, so please feel free to share your thoughts, your ideas, things you'd like to see me bring to the table in subsequent sessions. And again, remember that there is a shift coming to this particular class as we change up and move away from breakout patterns specifically to a more generalized price pattern discussion, but that begins in January. So with that, thanks again for being here. Have a fantastic Wednesday, everybody. Follow Cam and me on X and hit that thumbs up button below as well if you don't mind. Always great to see you all. Thanks for being here. I look forward to seeing you again real soon.